investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm coming to you from Mallorca, Spain, and we are broadcasting live. Rob managed to sort out those settings, so very exciting. Hopefully we won't say anything stupid because we can't fix live and edit. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, sounds like you had an exciting weekend. What was going on with you?
Yeah, had a great weekend. Wife actually, we had baby shower here for her. My mom threw that for her, and all her friends and family and in-laws were in town. Got some golf in with my father-in-law. Yesterday, yeah, it was a great weekend. Excited to get back at it, and yes, coming live. I'm sitting here, Orange County, California, as usual. Gary's always on the move, so we check in with him weekly on what we call the 5 things to know in investing for this week. My name's Rob Farian, as Gary said, CEO of Flying V Group. Gary, managing partner of Deep Knowledge Investing, where we bring investment knowledge, research, and understanding from Gary's experience, network of advisors to bring you everything you need to know about the markets and what's happening on a day-to-day basis. For this show, we're going to cover 5 things. Gary, we got a great episode called the CPI versus PPI issue, where we cover CPI. We're also going to be talking stocks like Nvidia. AuthID makes an appearance. We talk about deep knowledge investing portfolio companies. This is a position that DKI has held for some time now. We're also talking, of course, AI, Perplexity. What are they doing with Google, JP Morgan, China? Holy smokes, Gary, my goodness. We're going to have to start breaking this up into maybe a couple sessions. This is way too much for me to handle maybe on a Monday morning. But we're bringing it to you live. Gary, let's get right into it. We're talking CPI comes in lighter than expected. I'll let you do the heavy lifting in terms of what this means the Fed's going to do with rates, and then talking about the PPI as well. Very simply put, Gary, thing number 1, CPI, take it away.
All right. For those of you who are not glued to macroeconomics news on a regular basis, CPI stands for the Consumer Price Index. It's a monthly report that comes out when you hear people talking about inflation. They are typically talking about the CPI. Now, one of the things we've complained about at Deep Knowledge Investing is that the CPI is intentionally understated. It is designed to be inaccurate. And we can get into those reasons and what's going on, why it happens that way, the way they manipulate that another time. But anyway, for those of you who are new here, the Consumer Price Index is what people typically refer to as inflation. Now, last month, we got an overall increase of 2.7% for the year and an increase of 0.2% for the month that annualizes to 2.4%. The market was looking for as much as 0.4% for the month, so it came in light. That annual number of 2.7% is flat from June and was 0.1% below expectations. The core CPI, that is the CPI excluding food and energy, because as you know, nobody needs those things, was up 3.1% versus last year and up 0.3% for the month. That yearly core number was above last month's 2.9%, not the direction they want to go, and 0.1% above expectations. The main reason for that is shelter, which is a fancy word for inflation. The monthly was consistent with last month and in line with expectations. Going to some of the categories, and just so you know, every month I put out a 9 or 10 page report going through all the details. I don't paywall that. So for those of you who are interested, if you go to deepknowledgeinvesting.com, just click on the research tab and you can see in the blog, the monthly CPI report. For those of you who want more detail. Anyway, food inflation still elevated at around 3%. I still think that's too low. If your grocery bill is up only 3% for the last year, I'd love to hear from you. Put it in the comments. You'd be the first person to tell me, yeah, my food inflation is a single digit number. Energy prices continue to be a tailwind. They fell by 1.6%. And again, shelter is the key reason for the still too high CPI. Shelter, again, fancy word for housing. The one other thing that I want to emphasize is both President Trump and Federal Reserve Chairman Powell keep insisting that the current Fed funds rate is restrictive. One of the things we do at Deep Knowledge Investing is we track real interest rates. That is the CPI, the Consumer Price Index, less the Fed funds rate. And you know what? I actually just said that the wrong way. Pardon me. That is the Fed funds rate, less the CPI. But that is still below 2%. I assure you, for those of you who are long-term macro watchers, a real rate under 2% is not restrictive. So we're going to disagree with both the chairman and the president on that particular point.
Gary, my immediate thought turns to what everyone wants to talk about, and I'm sure what everyone would be interested in when it comes to CPI versus PPI is what does this mean for tariffs, rate cuts, right? How does it affect the case, obviously, that President Trump has for rate cuts, and obviously how he's using these tariffs within deal negotiations?
Well, Rob, so let's look at what people think is going to happen, and then let's talk about what's going to happen. So we saw people's expectations shift wildly during the week. When the CPI came out, because it was below expectations, everybody said, wow, the Federal Reserve is going to cut rates at the next meeting that's coming up. And, you know, the expectation was for 25 basis points, just a fancy finance way of saying 0.25%. But the probability of that cut went above 100%. Now, you might say, well, wait a minute, how is that possible? The answer isn't that the probability of a cut went above 100%, but there were more people saying, you know, they might cut 50 basis points. Again, fancy finance way of saying 0.5%. So, you know, everybody was very excited about that. As I said, people were worried that the monthly increase would be 0.4% instead of the much more manageable 0.2%. Now, that was the direction we were headed until on Friday, the PPI came out, the Producer Price Index. And that came in really, really hot, like scorching hot, like way above expectations. And the supposition there is that some of the tariff expenses are starting to make their way into the Producer Price Index. Now, the reason this matters and the reason the Fed is in such a precarious position at the moment is because price increases go through the Producer Price Index first, then the Consumer Price Index. Now, that might sound confusing, but it actually makes sense. Think about it this way. You're running a plant and you're making goods that people want. I don't know. You know, people love to use widgets as a fictional item. Okay, so we've got tariffs. Tires, exactly. Okay, so we've got tariffs, and say the price of tires or the steel that goes in the tires or the rubber that's used in the tires goes up. Well, you know, Michelin and Goodyear will see that in their prices first. They say, oh my God, well, you know, our prices are up. Guess what, consumer? We have to raise our prices. And a few months down the road, we see higher tire prices. So Chairman Powell is in a really rough position because the CPI seemed kind of manageable, but the PPI is indicating, uh-oh, we've got a lot of inflation coming. And so that caused people to say, you know, they might have to pause. Now, what people will be watching is later this week, Chairman Powell will be speaking out west. There's a conference out there, and he's typically used that as a way to...
Maybe I'll go try and meet him.
Yeah, there you go. Go see, tell him, you know, he can have a free subscription to Deep Knowledge Investing if he needs a better understanding of what's going on.
Invite him on the show and tell him, hey, we're just trying to see both sides.
Good idea. Go to Jackson Hole and see if you can get him on the show. I like that idea.
Oh, is that west? Jackson Hole's west?
Well, it's west of where I am in Spain. So, yeah, actually, you know what, Rob? While you're doing that, send a note to the Oval Office. Let President Trump know we'd love to host a debate between him and Chairman Powell here on the 5 things. Anyway, as long as we're dreaming, we're going to move on. So Powell is going to be talking about this later in the week. And when he does that, people are going to be saying, wow, you know, we're really curious. What's he saying? And they're going to be reading between the lines of everything he says. As usual, my guess is he's going to try not to be too direct on anything, any part of this. But the thing that we've talked about is I think the Fed is irrelevant. Whether the Fed keeps rates the same or they cut, it's not going to matter. And the reason is if they cut the Fed funds rate, which is just the overnight rate, you're going to see a higher 5-year, a higher 10-year, a higher 20-year bond. The yield on that will be up. And the reason is the bond market will price in higher inflation. They'll take down bond prices. This is what we saw in the United States last September when the Fed started cutting. This is what Great Britain just saw. They cut their version of the overnight rate, their version of the Fed funds rate. And guess what? The yield on their 10-year rose. So I think if Chairman Powell gives President Trump what he wants, which is a lower Fed funds rate, it may end up going in a direction neither one of these guys want, which is a higher 10-year rate, higher mortgage rate. So basically, the only way we're going to be able to get our inflation problem down is a cut to congressional spending. The probability of that is right around 0. So I suggest to people that you prepare your portfolio for more inflation. If you're having trouble with that, guess what? The Deep Knowledge Investing portfolio is heavily hedged and prepared to make money for higher inflation. That's what we think is coming.
Yeah, Gary, you've always mentioned, hey, regardless of what the market looks like, what decisions are made that are obviously outside of our control, hey, here's how we can position ourselves for if this, then that type of conditional logic, I think, has been very interesting in learning how you position yourself and set up everything within the DKI portfolio. Moving forward, we got a lot to cover on this week's version of the 5 things. We're actually getting a bonus thing. So welcome. Don't think we're liars here in the sense of we're just giving you extra value, 20% more on this week's version of the 5 things. Very rare. But Gary, next we're talking about Nvidia. We've got a 15% tariff on both Nvidia and AMD for their exports to China. Thing number 2, paying to play Nvidia and AMD's China chip sales agreement. What do we need to know here, Gary? What does this mean for domestic manufacturing, taxation of exports? Tell us everything we need to know.
So, Rob, the history here is actually really complicated. Right now, the United States makes the best AI accelerators in the world, and there's nobody even close. NVIDIA is clearly the global leader. AMD is making better chips all the time. And China wants to also be a leader in AI, and they want to import those chips. And it's been a source of political contention. Now, what happened was the Biden administration said, well, okay, NVIDIA, you can export to China, but not your very best chips. You have to cripple them. And what NVIDIA did was very clever. They technically complied with the restrictions, but were basically shipping chips to China that were this close to their very best chips. They weren't crippled nearly as badly as the administration had asked them to do. So the request wasn't phrased correctly. Then what ended up happening was, at some point the Trump administration said, okay, hey, we're stopping this. You can't export to China. You can't export even those crippled chips, which were still pretty good. What then happened was the Trump administration entered into negotiations with China, and China said, hey, we'd really like to have those chips from NVIDIA. By the way, wouldn't you really like our rare earth elements and magnets that you need for your technology, your automotive business, your weapons guidance systems? And basically, they had what we wanted and needed. We had what they wanted and needed. And the president said, okay, NVIDIA, AMD, you can go ahead and start exporting to China again. Again, not the very best chips, but the ones that are slightly less good. Now, worth pointing out, along with all of this, China had a long history of cheating on this. They were importing chips from Vietnam. There was some city in Vietnam that bought more chips than they had electric infrastructure. They were buying timeshare, right? So people were, they built their AI data centers, and China was just leasing this. I mean, the whole thing was kind of ridiculous. So we weren't really stopping them from getting the chips. Anyway, so what happened was President Trump said, okay, you guys can start shipping. And then he went to NVIDIA and AMD and said, hey, surprise, if you want to ship to China, you have to pay the government a 15% export license. This is different from our tariffs. Our tariffs are a way that we charge companies from other countries to import to the United States. If you want to sell in the US, you're going to have to pay. That's what the tariffs are doing. This is something else entirely. This is saying to our companies, if you want an export license, then you have to pay 15% of revenue.
Got it. And Gary, in terms of the deal, I mean, what do you see in terms of, does this set precedents for similar deals that are going to be moving forward between these chip manufacturers? Do you like this deal just in general? Where does this position us, the United States, as well?
So the fact is that Nvidia and AMD, they can stomach it. They can handle it. Their margins are enormous. And while a 15% revenue cut for them is significant, these AI chips have gigantic profit margins. They can manage it. But that said, I hate this deal. I despise it. It's terrible. And here's why. At DKI, we've been much more positive than most on the Trump tariffs. And we've understood all along the trade-off of national security and influence over China. We also understand more than anything else that in the United States, we've spent 40 years selling off our manufacturing capacity. That's not sustainable. We need to be able to make things here in the US. We have to be able to produce more than just financial services and producing dollars, right? That doesn't work long term. And so, we've been more positive than most on that, but this is not a good deal. And the reason for it is because the last thing we want to do is penalize American companies for exporting. That's how we build manufacturing capacity. That's how we build design capacity. That's how we end up at the top of the AI infrastructure play that's going on. Now, if somebody wants to say, well, it's dangerous to let China have these chips, then a 15% tax on Nvidia and AMD doesn't fix that. If the chips are dangerous to send, we shouldn't send them at any price. If we're going to send them, we shouldn't cripple our own national champions. And my fear on this is that this could be used as a precedent for other industries. Now, the reason Nvidia and AMD can manage it is because nobody else has other options. You can't go to other companies and say, hey, you can't go to Qualcomm and say, can you replace Nvidia? Right? Intel can't replace Nvidia. Certainly Samsung can't right now. They just don't have the design capacity to do it. They don't have the ability to do that. But what if we go to some of our other companies where there are competitors in other countries? That becomes a problem. Then we're crippling our own companies. That's the last thing we want to do. What we should be doing with our policy is encouraging American companies to produce and export. That's how we become more wealthy and more influential as a nation. That's the soft power that we should be using. So we've been generally supportive of the Trump tariffs, but I hate this deal.
Yeah, I mean, I think you're right too, just in the nature of AI and what's happening in this tech space, right? Is the boom is just happening at a rate that accelerated, and then this compounding infrastructure, information gain, right? Data explosion that you're seeing with AI. And then you're exactly right. It's like you're building that infrastructure that eventually is just going to overtake you, right? Because it's going to be so much more powerful and greater than you are with all those exports. So interesting stuff there, Gary. To keep it going, this is this week's version of the 5 things where we cover everything you need to know in the markets. We're covering everything from our own portfolio positions, big macro concept, educational topics, you name it. Head over to our website, deepknowledgeinvesting.com. You can grab a subscription for free, be added to our mailing list. And then for a premium subscription, gets you access to all ungated content, $100 a month. Basically everything Gary has to say and his knowledge and expertise on things he's seen. Gary, next point, really excited to talk about this, make an appearance. authID, DKI portfolio position initiated quite some time ago now. They recently posted massive revenue growth. I'll let you do the rest. I will say, this. I talked about this with you. I actually pulled back a little bit on my position just because we had seen so much volatility in the position, right? I know you and I have talked about some of the communication stuff, right? But hey, either way, I'm extremely happy. Still own this company with the results that they posted for this quarter. Gary, thing number 3, authID ticker AUID crushes the quarter. New deals on the way. Fill us in.
All right, so authID is a microcap with the fastest, most accurate biometric security in existence. They use passive selfie technology that is correct. It basically has 1 in a billion error rate. So if they did an authentication for every person on the planet, all 8 billion people, they'd be wrong 8 times. Really incredible technology. Over the last 4 quarters, revenue had been in the $200,000 to $300,000 range. This last quarter, the second quarter, $1.44 million. Revenue was up 415% versus last year. Annual recurring revenue rose from 1.2 million to 5.8 million. This was all recurring revenue. It all came from new customers. The company reiterated its guidance for $18 million of bookings this year. Worth pointing out, a year ago, that number was 3 million. So they went 3 million to 9 million, and they're saying 18 million this year. The revenue went from 200,000 2 years ago to 800,000, up 4x last year. Based on my calculations, this doesn't come from the company, but my back of the envelope math says the company will do a minimum of $4.5 million this year. And based on, depending on where their deferred revenue came from last quarter and how much revenue they're going to get from Prove, a new customer where they started billing literally this week, they could easily end up over 5 million. So let's talk about that revenue growth rate: 200,000 up 4x to 800,000. And then at that point, you're talking about maybe up 6 or 7x from there to something in the $4.5 to $5.5 million range. The 4.5 would be the minimum on that. And just an absolute incredible quarter by the company.
Yeah, great to see, Gary. Super exciting, especially when I see annual recurring. Love that, and especially love the model here. And know, obviously, based on the space, solid margins as well. Gary, in terms of the revenue growth, you said, I think, coming from new customers. I mean, were there any big announcements? New announcements? I think, again, as I mentioned, we've had the ups and the downs, right, with the communication coming out of the authID account. But yeah, what do you have to say about that? Anything that you can tell us there?
So, Rob, I think you're really hammering the key issue, both from the negative and the positive. The company has had abysmal communication, and it's caused the shareholder base to be very confused and upset. And the truth is, Wall Street hates confusion. We like certainty. And unfortunately, they didn't communicate all the great things that are happening. But just since last November, so we're talking about roughly the last 9 months or so, they announced a contract with an Indian company for $10 million over 3 years. Worth pointing out, this was a company last year that had $800,000 in revenue. So they signed a $10 million contract with this Indian company last November. In June, they announced a deal with Prove. That deal, Prove, by the way, is one of the global leaders in the authentication space. Their product, their suite of products, is a perfect complement for authID. Every week, they've been doing webinars with authID, and 2 weeks ago, the Prove representative described the authID Prove combination as the silver bullet in authentication. They already have, despite the fact that that deal was announced in June, they already have some of the technology integrated. They're working with a go-live customer with a date expected by this week. It may have actually happened starting last week. They're billing already. They also announced a deal with NEC, the $40 billion Japanese multinational. They together have put together something called the IDX platform. They have unbelievable capabilities and potential. IDX enables a company to authenticate employees from vendors and partners on one platform, regardless of company, location, or device. So imagine you own a warehouse and representatives from another company have to come and drop things off there or pick things up there. You can authenticate them. This is really important security. Now, You think that's enough? It's not. There's also a successful test that was just completed with tens of thousands of employees at one of the UK's largest retailers. This is a global Fortune 500 company. That's going to result in a long-term contract. We expect results or an announcement on that by the end of this year. That's not enough. There's a coming announcement of a huge contract with a Fortune 500 company that's a leader in the benefits space. So just in 8 months, you've got this giant Indian contract. You have Prove, NEC, a global Fortune 500 retailer in the UK, and a Fortune 500 company that's a leader in the benefits space. In addition to that, management said they're not done. They hinted at faster completion of other coming contracts. I expect that there will be other announcements this year, but management wasn't more specific than that. I don't have details on it, but they were very clear on the conference call that there's more coming. Rob, I don't think in my entire life I have ever seen such a small company make so many large, significant customer contract announcements in a short time. These are big name, Fortune 100, Fortune 500, tens of billion-dollar multinational companies. This is a tiny company. They've announced all these deals, and there are people saying, oh, well, their technology is unproven. I think their technology has been verified by the tech departments of all of these customers that they've announced. For those of you who are interested, take a look at the company. Unless you're satisfied with your current username, password security we're all misusing now, and we all know it's not working for anyone.
Yeah, it'll be interesting to see the continued advancement, right? These contracts, and it's a lot of big wins, as you mentioned, Gary. So super exciting things happening with authID, and I agree. Yeah, there's a big gap, just in security in general, right? From the top down, big business, small business, just old, antiquated username, password, shared password processes. Yeah, it's a great space to be in no matter what. Tons of growth and opportunity. Gary, moving forward, thing number 4, we're actually bringing in Perplexity into the fold, which super excited about. We have not talked about them much on the 5 things here. They actually made a $34.5 million bid. Gary, thing number 4, Perplexity submits a bold, like I said, $34.5 million bid for Google Chrome amid antitrust pressure. Wow. Yeah, that's big. That's actually huge. So very interested to dive into this and get your thoughts, and I will have some as well.
All right, good. So Rob, I'm just going to correct you on one thing. It was not a $34.5 million bid. It's $34.5 billion.
Billion, excuse me.
Yeah.
Yes. So
With a B.
okay, I was excited at 34.5 million. So now I'm just
1,000 times more excited.
Yeah, there you go. Thank you. It's early
Exactly.
on the West Coast, the real West
Exactly.
Coast.
All right. So Perplexity is an AI startup. It's a private company valued at about $18 billion. And they made an unsolicited all-cash offer of $34.5 billion for Google's Chrome. It is a calculated move, and the reason is Google is currently in front of an antitrust court. The truth is Google has been not so good on the antitrust side. Most of our big tech companies have not always been great on that, and you know they're in front of U.S. District Judge. Hold on, let me get the name right. Amit Mehta. I wonder if it's Meta or Meta.
Yeah, you got it. Yeah, Meta.
It's Meta. That's what I thought. All right, good. Yeah. For our Indian viewers, correct me if I got it wrong, please. Anyway, they're looking for potential remedies in this antitrust case. Spinning off assets, including Chrome, could be one of them. I don't think Google wants to do that, but you know, we'll see what Judge Mehta says in terms of their options. Perplexity did agree to allow user choice, to keep Chrome open source, and to commit $3 billion over 2 years toward development. Sale negotiations seem unlikely. I don't think Google has any interest in doing this. And then making things even more fun, Search.com entered the unsolicited bidding. They put in a $35 billion cash offer backed by JP Morgan. Wow. So everybody's circling Google on this one.
Well, and I mean, Gary, I think it's what we were talking about earlier with Nvidia and their chip case, right? Because what I've been talking about recently is Google, for the first time, more or less, right, over the last 20 years, has been driving almost 100% of all of traffic and controlling that, right? Controlling it through Chrome, controlling it through their extensions, controlling it through search. And we've seen it with our own website traffic on Flying V Group. Same thing. For the last 10 years, it's been exactly that split as well. Well, just over the last 6 months, you've had that go from 99.9%, right, to wait a minute, all of a sudden ChatGPT, LLM, Perplexity, it's at 97.9%, which, someone might say, well, not a big deal, right? We're talking about huge movement, right, of volume and source attribution. And then not only that, but what we're seeing, the value on that traffic that's coming, to where a lot of that Google traffic is just, it's just not as good, right? It's not as valuable. It's not as high intent. And so this is interesting in that Google's in a situation where they almost have to maintain Chrome, because that's where they're getting all their user data information, and they're on the arms race, right, to obviously accelerate legacy Google search. But then, you have this antitrust that Perplexity is using against them, to where if you turn Google Chrome over to Perplexity, again, that wave just might be, it could be big. I don't know what that means. I'll never count Google out of anything, obviously, but it's just a crazy dynamic. And yeah, it does lead me to my question for you on the deal side, or antitrust wise. I mean, how much pressure does this put on Google to do something, and what should they do, or how should they navigate this?
So first off, always interesting talking to somebody who runs an advertising firm on anything Google related, right? I mean, their core business really is advertising. So really interesting to hear, your description of it. And you're right, going from 99.9% to 97% doesn't sound like a big deal, but not only is it a lot of money, the competitors went from 0.1% to 3%. That's a 30x, right?
Fast.
Yeah. Now, I'm going to tell you honestly, my view on this is very mixed. On one hand, when it comes to Google, I do love YouTube, and certainly, we're broadcasting there now, and we've enjoyed growing the channel there. But I watch it myself every time I need to learn to do something, or sometimes in the evening. It's just a nice way to unwind. Funny pet videos, stuff like that. Or, interesting film analysis or literature analysis. It's just great stuff on YouTube. I really like it. And then, I'm, of course, one of those crime thinkers who uses Samsung phones and tablets, which are built on Google's Android. So, I like that as well. But there really is an issue with Chrome, because there are legitimate concerns about how Google uses Chrome to gather data and invade user privacy. And I can tell you, the reason I have never used Chrome is because the first time I tried it, it was very, very difficult to do things like erase your browser history, or, clear your cache, or say, hey, please don't store information about me. Please don't store this. Please don't use this, right? And somebody might say, oh, well, if you have nothing to hide, that's completely beside the point. I don't think there's anything that interesting in my browser history, but that doesn't mean that I want it stored and used and sent to advertisers, right? That's just, when it comes to privacy, I'm very much a civil libertarian. And this is an issue for Google. Do I think any of these offers are going to force Google to sell and enter negotiations? No, Google's not going to do that. But what it does is it puts in front of Judge Mehta Google no longer can say, oh, we couldn't possibly spin this off. It would be too complicated. There's no interest. No, there is. There's already a bidding war from companies who are saying, yeah, we'll take this, we'll leave it open source, we'll invest in development, we'll give people a choice of which search engine you want to use on it. All of these things are very pro-consumer options, and it'll make it very hard for Google to say, oh, well, this couldn't be done. It absolutely can be done. And so a big part of it, and this I'm gonna credit DKI's interns. This was great writing here. I'm reading what they wrote over the weekend. Perplexity's aggressive bid is a masterclass in strategic opportunism, calculated, bold, and undeniably shrewd. By stepping forward as a potential owner of Chrome, the startup flips the script, no longer just chasing users, it's chasing influence. These are 19-year-old kids writing this stuff.
Yeah, but I mean, that's I hear you in terms of one crediting them, but also I'm not surprised because of how advanced I've seen that group, right? In understanding how these technologies are used, the influence, you hear influence, right? And everyone thinks just influencer, influencer this, influencer that, right? And sure, yeah, there is a market on that side of influencer marketing that is kind of, I don't really use it much at all, right? But then you think about it on the flip side, well, 99% of influencer marketing is just controlled by Google, Meta, right? Big brands with influence and authority. They're just doing it through their brand. And so, yeah, it's such an interesting dynamic just to see where demand is being pulled from, and it's through attention, visibility. And I think you mentioned it. YouTube's a great one, in terms of argument for Google, in my opinion, is that is something that's providing real value, right? It's unique, it's decentralized user base, right? It's not just mainstream media pumping the stuff through the pipes, and it's cheap, right? And it's accessible. So it's gonna be wild. It's we're in for a very interesting next couple of years with this AI arms race and these big tech giants just laying blows, and obviously the geopolitical stuff that's going on here as well. Just absolutely fascinating. This is the 5 things. I know we're running a little long today, but so much good stuff to talk about. We got a few more here to cover. One more thing to know for the investing week. When you get out there in the market, if you have any questions, head over to deepknowledgeinvesting.com. You can use the Ask Gary feature. We've also got some cool new features that are going to be rolling out on the website that allow you to pick different pieces of the site from an AI perspective, query certain things, as well as just old-fashioned email Gary at ir@deepknowledgeinvesting.com. We'd love to have your questions show up on this week's or next week's version of the 5 things. Gary, moving forward, President Trump, of course, makes an appearance. It's about tariffs. It's about China. I'll just get right into it. Thing number 5, Gary, President Trump extends the tariff truce with China. What does that mean? I feel like with a lot of conversations I've been having, actually just met with a couple of gentlemen, UK manufacturers, right? And just saying, hey, we just don't even really know what's going on, right? So yeah, help us understand, what does this mean? What's real, what's not?
Yeah, I don't think it actually means anything, and I don't think it surprised anyone. Basically, the president signed an executive order extending the current extending a 90-day pause on tariff increases against China before the previous truce was set to expire. So basically, the rate for China is supposed to be much higher than it is now. He took those tariff hikes off the table for 90 days while they negotiated. And, it's a complicated deal. And that's basically it. It's complicated. It's going to take them more than 3 months to sort out. There are a lot of moving parts, a lot of products, a lot of, questions about it. And so basically all he did was said, okay, we won't raise these, we're out of time. We won't raise these tariff rates on you for another 90 days. Let's keep talking. Let's see if we can sort it out. And basically what it did was froze the current tariff level is right around 50-something%. And it kept the number from going up to 145% with a 125% retaliatory tariff by China. Basically, both sides said, okay, let's not blow up our whole trade relationship. Let's just keep talking for another 3 months. I don't think this surprised anybody. And, I don't think it's really indicative of anything other than the fact that these deals are very difficult and our ties to China run very, very deep.
Yeah, Gary, I know in the written version, right, talking about how closely aligned, we need to be with China. You always talk about decoupling from China, reducing our dependency on China. I mean, is this just another consistent theme of, yes, we need to continue to do that?
Yeah, we absolutely need to. And I know every time I say that, people get upset. And that's okay. Go ahead and get upset, but, make a better point other than, hey, you're an idiot. You don't understand how economics works. Cause I find that annoying
those are the best comments, actually. Those are my favorite ones. You need to start replying to those ones.
Not a chance. No, I'm not engaging with nonsense. But look, let's do the thing that we're telling other people they should do. Let's give reasons, right? First of all, our current trade deficit with China is about $300 billion a year. And somebody might say, okay, well, so what? We're getting all sorts of cheap goods from China and we're printing dollars to do it. Okay, great. But here's the situation. That's $300 billion of stuff we used to produce in the United States. And, it's really easy. Listen, I can manage under this economy, right? I'm a finance guy. I live right outside of New York. My business is not affected by this, but I grew up in the Midwest, right? I spent the first half of my life living in Michigan. And certainly, we're surrounded by people in Ohio and Indiana. And, the amount of industrial sabotage there it's just been unbelievable carnage. And places that used to have jobs and mills and factories and made things have been completely sidelined, and entire towns are dying from fentanyl overdoses. And you might say, okay, well, hey, learn to code. Well, besides the fact that that's incredibly insensitive, leaving that aside, this is a situation that is completely unsustainable. We spent 40 years selling off our manufacturing capacity. We don't have enough manufacturing capacity to keep selling that off for another 40 years. And great, we're a leader in financial services. Okay, that works for me. And Nvidia and our, great tech firms, they're national leaders, they're worldwide leaders, but okay, we need more than that. This is a national security issue. It's an employment issue. It's a self-determination issue. We can't just keep importing everything cheaply from everybody else. It just doesn't work long term. The other thing is, China has been conducting asymmetric warfare against the United States for well over a quarter century. And somebody might say, okay, wait, that's a lot of fancy words. What does that mean? And what it means is they are conducting all kinds of non-military warfare against us. And they're doing this in all kinds of ways. We're going to give you just 2 examples. And if you want to do the research, I'm sure you can find 20 more. But 2 examples that we've talked about at great length this year. One, there was the Microsoft hack. That came from China. Right? They were hacking into government offices and private corporations. This is a huge issue. But actually, I said I'm going to give you 2. I'm going to give you a third. They've been trying to hack all of the utility companies. Every day, these companies get hit with thousands and thousands of attacks, all coming from China, trying to be able to control our grid. That's not for anything good. And then, finally, we talked about, people are saying, oh, great. Well, we get these great solar panels from China and this great Green New Deal stuff. Okay, terrific. But they were hiding spyware and malware in the solar inverters. And for those of you who didn't see this version of the 5 things, basically that's the equipment that we use to get power from the solar panel to the grid and allow China to basically damage our grid. So my question for the people who don't like hearing me say we have to decouple from China is, how much cheap crap is worth it to be doing business with somebody who's actively trying to hurt you in all of these ways?
It just absolutely blows my mind. The value proposition and the consumerism, I think, on the U.S. side, right, is what it feeds it. I don't know. Even for me as an advertiser, like I don't buy anything online. And maybe that's where I need to, think about but it just seems to be, it's just some of this stuff. It's like, why do we need that? And then, of course, where's the majority of it coming from? And then, your point, it's right. It's like, we just have centralized hubs in the United States, right? Where all of our value is coming from now. And what are they doing? It's just easy attacks, right into malware, spyware. And I think that's why you and I have, especially authID. I know I've talked to you. I've looked into some private VPN security based companies, right? B2B, etc. because yeah, we've experienced it. We've experienced it as a small medium-sized business.
Yeah.
Legitimate attacks. Just within our portfolio of information that we have and value, etc. So yeah, I think it's something that everybody needs to be aware of, both privately at a personal level, right? Especially high net worth individuals, family offices, right? And then as well as obviously just B2B. And unfortunately, I think it's the small, medium-sized businesses, right? I mean, those are the ones too that they just can absolutely prey upon. And then that just gets them access from one to the next, to the next, to the next, right? And yeah, it's just a vicious cycle. So we're definitely taking a look on our side too, just in terms of IT infrastructure security, or have somebody that you can call, right? Have somebody that knows what you have going on, so you can be ready and proactive. Gary, I'm going to keep it moving forward. This has been great. This should be a 2-hour show at this point, fireside chats, right? But Gary, thing number 6, again, 20% extra value this week on the CPI versus PPI issue. DKI's 5 things to know in investing this week. We're talking our educational topic, understanding call and put options. I know in my conversations, again, amateur investors, novice, right, learning, becoming intermediate, growing as we're understanding markets, business, etc. But this is always one like, okay, understand buying, selling. What are these option things everybody's talking about? So Gary, let's start. What are put and call options?
All right. So we're just going to make this really simple. An option is the right to buy or sell 100 shares of a stock at a particular price at a particular time or before a particular time. So if you have a call option, say, I'm going to make this up, say, end of September, $100 call options on a particular company. Each one of those enables you to buy 100 shares of that company on or before the end of September for $100, and the price could rise, and you could make the money that you would make would be the difference between $100 and the current stock price, less of course the cost of the option. Now, put option works exactly the other way. If you own a put option, it gives you the right to sell 100 shares of stock at that same price, or whatever price you have as the strike price on the put. So calls, you have the right but not the obligation to buy. Puts, you have the right but not the obligation to sell, and they all have an exercise price. That is the price at which you have agreed that you could buy and sell. They have an expiration date, right? And there's an underlying security. And those are the key things that you're going to look for. Now, some people who are experienced options traders will say, okay, wait, but there are other things too. There are the Greeks, there's Gamma and Vega and Delta, and these various other other factors that go into the price of the options. That is all true. That does all matter. It's beyond the scope of a basic conversation. And our educational topic, we really want to make sure that we don't go into advanced calculus and just keep things approachable for people. So when at the basic level, we're going to simplify it. You have the underlying security, the date of expiration, whether it's a call or put, and the final thing would be the exercise price. So I think we've explained all of those, but if any of this isn't clear, ask the question, put it in the comments. I promise you we'll give you a good answer.
Yeah, IR at deepknowledgeinvesting.com. You can head to the website, deepknowledgeinvesting.com. Click the Ask Gary link at the top of the page. Okay, Gary, let's break it up. Calls, buying a call, selling a call. Walk me through that.
All right. If you buy a call, the maximum amount of money that you could lose is the amount of money that you spend on the call options. You can't lose any more than that. The call might expire worthless and you're just out the money that you spent buying the option. The amount of money that you could make is theoretically unlimited. So if we use the example we gave before, you buy 100 strike options, maybe the stock is at 80 and I'm making this up. It goes from 80 to 1,000. Well, guess what? You would make $900 per share. times 100. Well, you've done pretty well on just one option contract, but your theoretical gains there are unlimited. When you sell a call, it's the exact opposite of that. You are guaranteed to take in the option premium. That's the cost of the option. And you get that. That is your profit. That is your money. And that's guaranteed that you receive that. But the amount that you could lose is theoretically unlimited. It's the other side of writing that option up. Somebody might say, well, wait, why would I ever do that? And the answer might be you might own the stock already. And so you could deliver your own stock against it. Or, you're willing to buy those options at that stock at a particular price. I mean, there are all kinds of reasons you would do something like that. Or if you just think things are mispriced, there are various ways to control risk. There are spreads that you can set up. Again, it gets very complicated, but the simple version is when you buy, you are definitely out the cost of the option. Your profits are theoretically unlimited. When you sell a call, you definitely receive the cost of the option. Your theoretical losses are unlimited.
Got it. Gary, let's flip the script now. Buying put, selling put. Walk us through it. And just so everyone knows, we have a written version of the 5 things. So every week you've got a written version, material, graphics, right? We'll have to get I know we chopped this up. This is the live version, but the chopped up one, I think we'll have a graph up there, right, with our graphic. We're improving all this stuff, but yeah, just so everyone knows, multiple different versions of the 5 things: audio, video, written. So make sure you get whatever you need to get all this good information. So Gary, buy put, sell put.
Okay, yeah, Rob, you're making a great point here. The graphics that we use in the written version do make things much more clear, and they're designed for that. Anyway, put options, it's the exact opposite for call options. If you buy a put, you will definitely be out the cost of the put. And what you're hoping is that the value of the security, the price of the security, will decline. Now, your gains, your potential gains, there are limited to the difference between the exercise price and 0. The stock can't go below 0. So you can make a lot of money on a put option, but not an unlimited amount if you own it. If you're selling a put, it's the opposite. You are guaranteed to receive the price of the option. So you're going to take that in. If the stock stays the same or rises, if it's above the exercise price, your profit will be the price of the option that you took in. If the stock drops, the most that you could lose is the distance between the exercise price and 0 less the money that you were paid for the option. So you could take large losses there, but not unlimited losses. And again, people who do this may own the underlying security. They may be hedged in other ways. They may be buying one option and selling another. There are all kinds of sophisticated strategies. So the risk may not be what it appears to be in a particular security. Or, one of the things that we'll do sometimes is, I might say, well, I don't want to buy the stock at a current price, but I'd buy it down $20. I'd buy it down $30. If you sell put options, then if the stock goes up, you take in the value of the option. You take in the price of the option. But if it goes down, you may end up getting to buy the stock at the price that you wanted. So there are various ways to use these things to control risk or add to profits.
Yeah, and Gary, I think my question, I kind of laugh, is what's the difference between like professionals, I'd say, and how amateurs or novices maybe should be using call and put options? And I always laugh because I think one of the things that you told me when we first started talking was, Rob, how would you feel if I was the other guy, I meaning you, or the other guy on the other side of your trade? And I said, well, Gary, I probably would not feel very good about that trade, because that means you think the inverse of what I'm thinking, and you're spending a lot more time on this stuff. Not that hey, we don't make mistakes, or I see things different ways, right? You learn in every which way. But anyways, yeah, some of this stuff can get complicated. Intermediates, amateurs versus professionals in terms of use of these options.
Yeah. So, Rob, one of the things that inexperienced amateur investors will do is they just use options to magnify potential gains and losses on stock positions. In recent years, we've seen a huge increase in the 0 day to expiration options where people are buying options on the day of expiration, hoping that the underlying stock will move. And, if it doesn't, they lose 100% in a day. If it does, they can make a lot of money in a day. I was talking to a friend of mine the other day, and he turned in a matter of a few months doing stuff like this, $7 into $1,500. And you think, okay, wow, that is phenomenal. Good for you. And I said to him, okay, what happened next? He said, well, I lost it all. And in his view, he said, but I only lost $7. I don't know. You ran up a $1,500 profit, but there was no risk control on any of that. These generally, doing this kind of stuff is really much more akin to gambling than it is to investing. Professional investors will often use options instead of to magnify gains and losses. We'll use them a lot of times to modify risk, to create synthetic shorts. That's selling a call and buying a put. I'll use spreads on things where I may buy one option and sell another option that's further out of the money just to control risk. We'll do things like sell a stock that we own above the current price, that's selling a call, or to profit while trying to buy a stock at a preferred price, that's selling a put. This is something we talked about, in an earlier part of this segment. There are all kinds of different trading strategies that can depend on timing, catalyst, whether the investor already owns the underlying stock. So there are all kinds of things that we're considering in terms of risk control and portfolio management that the people buying 0 day to expiration options are not. As always, we advise proceeding with caution, having a clear investment thesis, and thinking very hard about whether you're taking unintended and unlimited risk or not. At DKI, we have used options occasionally and very profitably when positions trade down substantially on news that we consider to be temporary or unimportant. But to do that and do it well and do it profitably, you really have to have an investment thesis on this stuff and have to know how much you're risking and be able to limit that risk. Those positions have tended to work out really well because we do have a clear understanding of why a position is down and why we disagree with the market on that. For people who are interested in subscribing, our goal is to make you a lot of money, help you make a lot of money over the long term. Please don't think that, every week there's going to be a new options trade that makes us 40%. It does happen on occasion, but this is not, a regular part of the business. It's really just when something dislocates and we see a very unusual opportunity. So we do this stuff profitably, but not on a daily basis.
Great stuff there, Gary. And yeah, if you have any questions, head to deepknowledgeinvesting.com, use the Ask Gary feature, and we'll get those answered for you for sure. That concludes this week's version of the 5 things, the CPI versus PPI issue. We'll be back on next week. We're still dialing in exactly live times, releases. We'll have to get a schedule out, maybe, Gary, so everybody, maybe everybody knows. But yeah, Gary, turn it over to you for final closing thoughts, and we'll wrap this up. I know we ran a little bit long today, everybody. Apologies for that. But again, 20% more value.
There we go. All right. So, Rob, first of all, I want to thank you and the team at Flying V. We continue to improve the 5 things, and a huge part of that is because of the efforts of you and your team there and the resources that you pour into doing this every week. And just the fact that you get up early on a Monday morning to film this with me is incredible. And for people watching this, if the marketing team that you're working with isn't putting that level of personal attention and effort into what you're doing,
be careful.
Yeah, give Rob a call. He'll do it with you.
No, give someone a call. Give someone a call. Call me. I'll figure it out.
All right. Also, really importantly, our young interns do a phenomenal job. Cash and Crow, Samak Chain, and Gideon Rodham. These are young guys, and they work their rear ends off every week. I've said this a million times, but I get to be, on camera talking about all this stuff. But so much of the 5 things is based on the work, the research, the writing, the image production that our young interns do. They really do a terrific job. Round of applause for them. And, we should give them a ton of credit for it. Finally, for those of you who are watching, we really appreciate it. We know your time is valuable. Thank you so much for spending it with us. If you want to give us a like and subscribe, we'd appreciate it. But hey, we're not the boss of you. Do whatever you want. We'll see you next week.
Thanks, everybody.